Hello and welcome back to the Ideal Wealth Grower YouTube channel. My name is Axel Meyerhofer. I'm the founder of Ideal Wealth Grower and the host of today's episode. So today I like to talk to you a little bit about where are we going with our real estate investments and real estate in general in these pretty advanced markets. And I mean advanced in the sense of how can we strike a balance between the rent income that we are looking for and the prices that have kept increasing on and on and on. There was a little bit of a, I would say a little bit of a pause, I think in June, where it looked like my prices might maybe plateau at a certain level. But now the latest data for July and early August has come out again, and they have kept rising. I think we are 18% higher between July 2021 and July 2020. And even if you go back further, it's even more crazy. So one of the things that actually then becomes an issue is that, I've always been talking about the 1% rule. And the 1% rule basically says we are looking for properties where if we buy a $100,000 property, we want to be able to collect $1,000 rent. If we buy a $150,000 property, we want to be able to get $1,500 a month in rent. That would be the 1% rule. Now, two things come into play. Up until recently, the prices of the properties kept increasing, and that was mainly, as you can see on some of the other shorter videos that we have done in the past, that is really a result of supply and demand. If there is very little inventory in the market, then like with anything, if it's rare, then it becomes more valuable because more people want to have this rare thing. Now there are certain accelerants, right? Like, so for example, people who want to no longer be in a rental complex because it's relatively tied together are added to the people who just in a regular year under normal circumstances, pandemic or not, would be interested in finally moving into a house or maybe going from a small house into a bigger house. So the number of people that were looking to get into residential real estate has increased, while at the same time the number of properties up for sale has decreased. And part of the reason is a lot of people in the last few years have heard the news in the media and everywhere that interest rates have gone down and have asked themselves, how can I take advantage of that? And so there are two components that actually play a role in this question. Is number one, can I get a lower interest rate than I already had? And I have to tell you, when we started getting into real estate, interest rates between 6 and 7% were totally normal if you occupied the property, and if you were buying investment properties, they were between 7 and 8%. And then rates started coming down. So I would say probably 3 years ago, when we got anywhere between 3.5% and 4.5% interest rate, we thought we already had a really great deal. But with all the economic turmoil and the COVID stuff and the money being pumped into the markets and all these kind of things, interest rates have gone down further than anybody would have probably anticipated. So if you look at your mortgage and you have a 4% interest rate, or 3.9 or something like that, and that was considered really good, you can get something like 2.9 on a refinance now. So that's a whole percentage point. Now, the other thing that's an interesting consideration that people made when they were contemplating, okay, do I even consider buying a place, a different place, or staying in the place I'm at? So if you were to refinance, which a lot of people did, you would lower your payments that way. But the other thing, and that is something that is oftentimes really easily forgotten, is at least in the past, the average was somewhere between 7 and 8 years of people staying in their property. And that takes into account anybody who moves around quite a bit and gets into a different property every 2, 3, 4 years, as well as people who stay in properties, especially when they're a little older, 10, 15, 20 years. So the average came out to be around 7. The average also has kept increasing in years more and more. So people stay in their properties for a longer period of time. But when you look at it, if you own or live currently in a property and you are within, let's say, the first 10 years, you would probably, when you bought the property and didn't have 20% down payment to put into the purchase when you got the property, you would have gotten what's called mortgage insurance. And you pay that mortgage insurance as your part of your monthly payment, which is for the principal, for the interest, for the mortgage insurance, for property taxes, general property insurance, all those kind of things. So you have one monthly payment, and the mortgage insurance is part of it. So when you refinance, there is a huge aspect to consider that a lot of people find out when they actually look into it and then come to the conclusion, well, I don't really need to move. And even though the moving concept or the idea of moving may not be motivated by how much money can I save, but if you fundamentally don't have to move, which a lot of people, now that we went through 18 months of COVID, have gotten used to actually staying in the property, not having to commute to work anymore, not really looking forward to do that anymore. And now think about that scenario. Let's say you live in a property that had cost you $2,500 at a 4% interest rate with mortgage insurance. And now you refinance that property and you get from, let's say, 4% to 2.9% interest rate. So that makes a good chunk of difference, because it's basically almost a 30% or a 25% reduction in the interest part, right? Now the other thing is, when you get refinancing, you're also going to get a new appraisal. And let's say your property, if you say a $2,500 mortgage or payment a month that you do, that's probably something like a $300,000 to $400,000 property, but 5 years ago. And if you look at that amazing appreciation pretty much all across the country, that property could easily be $450,000, $500,000 worth now. And in that time that you owned that property, every month you paid off a little bit on the balance of your mortgage. So if you started out, let's say you had a $350,000 property and you put, I don't know, like $30,000 down or something like that, or maybe $35,000, so that's 10% down payment. Then you had $320,000 as your mortgage to pay, and you paid down a little bit from there. And let's say you had the property 5 or 7 years, you probably paid down in that period of time, I would say easily $10,000, maybe even closer to $20,000. So your remaining balance on your mortgage is $300,000. And as we just said, with that amazing increase in valuation and appreciation, it is worth $500,000, or maybe $450,000, or maybe $550,000. But definitely when you make the calculation, you don't have to pay mortgage insurance anymore when you have 80% or more covered, basically, meaning like you have 20% or more equity in the property. So let's say, for the easy example, your property is now worth $500,000, 20% would be $100,000. So your mortgage is $300,000 and 20% is $400,000. So you have plenty of buffer in between. When you get a new mortgage to pay off the old mortgage at $300,000, there is no need to have mortgage insurance anymore, because you have plenty of equity, more than 20% in the property. So the reason that you have mortgage insurance, and we made videos about that a while ago, is because the bank is saying, well, if you don't pay, then what do we do with the property? But now that the property has basically $200,000 of equity in it, that risk is very, very low to the bank, and they also look at the market and see the prices are increasing. So if you for some reason wouldn't pay, they have no problem selling the property for a reasonable price, even if they don't get the $500,000, but they would definitely get $300,000, no doubt about it, right? Especially in today's market. So that's why they wouldn't make you pay mortgage insurance anymore. So what does that mean? You save 25% on the interest compared to your old mortgage, and you don't have to pay mortgage insurance anymore. So you live in a more higher value property for maybe closer to $2,000 rather than $2,500. So that is a real good reason to say, well, as long as I can still accommodate myself in the property, I like it, I'm used to it, I don't really have a strong reason to leave, then refinancing and keeping it and enjoying the appreciation that it had gone through is, in many people's mind, the better option. But what that does, if you go back to the bigger scheme of balancing the situation, is that anybody who makes that decision to say, I rather refi for slightly below 3%, and I don't have to pay mortgage insurance anymore, so I have less payments per month, I just stay and keep that lower mortgage and that lower payment and stay where I am and don't have to go through the hassle of moving and stuff. But for anybody who looks for a property, now that property is no longer even being considered to be on the market. So that's where the shortage of inventory on the market comes from. Now for us as investors, we would ask ourselves, how can we cope with this continuous increase in prices? And one of the things that you have to keep in mind is that we have now choices that we didn't necessarily have 3 years, 5 years, 10 years ago. It used to be that when you were able to find what I've always called the ugly duckling in the neighborhood, and you were looking as an investor to make the 1% rule, then when you're working with out-of-state turnkey in companies like we do, and we help you to do the same, then these companies would find a property, let's say between $25,000 and $35,000, 3-bedroom, 2-bath, somewhere in the Midwest or in the South, and they pay, like I said, $25,000 to $35,000. Now that's a pretty ugly duckling in a nice neighborhood, really run down, but it has what's called good bones. Then they go in and say, okay, let's put $45,000, $50,000 of renovation. We put new plumbing, new electrical, new appliances, new bathrooms, new kitchen, new floors, sometimes new windows, right? So they make it basically almost as new, except for the bones, except for the frame, except for the foundation. Now, if you think about it, let's say they bought it in the middle, like 30,000, they put 40,000 in. So now they're at 70,000 and they sell it to you or me for 100,000. That used to be the deal. And a nicely, freshly renovated 3-bedroom, 2-bath house in the Midwest with a garage, you can rent for $1,000. That was our 1% rule. Now that same property, and I have actually examples of that in my own portfolio, is now going to be valued at probably something like 130,000, 135,000. And the issue that comes with that, so far at least, we have not been able to increase the rent quite as rapidly, even though rents are increasing currently pretty rapidly. But if you're coming from people having paid $1,000, just because the value of the property has gone up, it's not very likely that you can increase the rent by 30% and say, now I want $1,300. So what can we do, and what is the additional new option that we have? And this additional new option that we have is to find turnkey providers who also build properties for the sole purpose of renting it out through an investor. So if you have a turnkey provider, you always have to keep in mind, normally, traditionally, so what do? They find what I call the ugly duckling in the neighborhood. They spend $25,000, $35,000 and then put the money in for the renovation and then sell it to us as an investor. But not only that, if they meet the criteria that I've always been preaching and that we're teaching to our clients, then they would also be, at the same time, immediately after they sold it to us, they would be the ones who actually manage the property. They would be the ones who find the tenants for us, who collect the rent, who go out if there's anything to repair and do the maintenance on the property, all that together in one big package. That is a turnkey provider that meets the criteria that we have traditionally set. So now there are also turnkey providers who say, okay, we buy a piece of land that allows for, let's say, 25 new single-family homes, and they build 3-bedroom, 2-bath homes at like 12, 13, 1400 square feet with a garage, maybe a little smaller lot than an existing house, and building it brand new, as you can imagine with the current prices for all the raw materials, is more expensive than renovating a property. But the benefit is you can pick the property itself in a really nice neighborhood, in what's called an A-class neighborhood, and people typically pay a premium if they get better value. So if you get a brand new house in a brand new neighborhood that is a really nice new neighborhood, is understandably more valuable than a neighborhood that exists already for a longer time, is maybe a little bit more mature, but also might not have all the trimmings and fixings that you could see and find in a newer neighborhood. And you can't move a neighborhood. So if it is a B-class neighborhood or a C+ neighborhood where we would normally find those 1% deals, you can't really change that. That's kind of the neighborhood as it is. But when you create a brand new development, you can pay particular attention that it's in an A-class neighborhood, which automatically means you can ask for higher rent. And on top of that, you can also ask for higher rent because it's a brand new house. And for us as an investor, the benefit is that there is very likely any need for any repairs, and we can even get a very affordable insurance because insurance companies also know that it's not very likely that something breaks, and if it does, then it's typically under warranty. Now, does that mean if we were to get a build to rent or build to invest house from a turnkey provider who does that we would meet the 1% rule? And the answer is no, we wouldn't. And so I did a little bit of research recently to find out where is the true number, because the thing that we are really looking for is long-term cash flow. And I will never go to the point where I'm saying buy a property that doesn't really pay for itself or has any positive cash flow, because you're hoping that this kind of unusual situation, at least I think it's unusual, that we have these really substantial price increases, 8, 9, 10, 15, 18% year over year, would continue. But if that were the case, then you wouldn't even need to look for cash flow. You would just buy a property, rent it out for 5 years. If it increases 10% per year, it's 50% worth more, and you can sell it and collect the money that you make in the difference. And the fact that you had rent is just so that the mortgage is paid. But our approach is we want to get to the time freedom point. So that means when we reach that point where we have the freedom to do with our time what we want and no longer have to exchange time for money, that is the point where the amount of positive cash flow is sufficient to pay for everything that we need to live on a monthly basis. But it doesn't end there, it just starts there. So we wouldn't sell the properties when we reach the time freedom point. We would just sell our job or get rid of our job, but we would keep our assets so the money can keep coming in. What does that mean for the 1% rule? It means that when you go with a build to rent brand new property and you get the proper insurance, you can go down to about 0.7, right? So if you get, let's say, a $200,000 property, because you have to assume that a build to rent property is more expensive than a renovated one. So a renovated one would probably be $150,000. The brand new on a brand new plot of land, brand new build right now, is probably $200,000 for the same kind of property in a nice neighborhood. And 0.7 would mean you would be able to get $1,400 or maybe slightly more than $1,400 in rent. But even with that, and because of the low interest rates, you would still have a little bit of positive cash flow, just not as much as you would have if you had the $2,000 that the 1% rule is. So you may have $50 or $100 for positive cash flow, but you also know that for that situation, you probably have for years no real concern for maintenance. Now, the other part is also that you can, when you get into these build-to-rent properties, make a point that you be more selective on the agreement for the lease agreement, for the tenant, right? I would say when you go for a build-to-rent property, you would want to put a rule in that you say the tenant needs to sign for 3 years. Right? Because that way you also know you have this rental income secured, and the most expensive thing in any kind of investment property is turnover, meaning like when you have a tenant for a year and then they move out and another tenant for a year and they move out. If you have a tenant for at least 3 years, a couple of things happen. Number one, they start liking their place. If everything is the way they like it and they're living basically from day one in a brand new house for 3 years, it's not that easy to find something like that. And even if you increase the rent $50 or $80 a month per year, so that you go year 2 from $1,400 to, let's say, $1,475, and then in year 3 you go from $1,475 to, let's say, $1,550 or something like that. So you're slowly working your way closer and closer to your 1% number. But they would probably accept that, especially as prices are increasing all over the place right now. In light of the fact that they will know the neighborhood, everybody moved in at the same time, it's new houses, only 3-year-old, no repairs, all those kind of things make it very likely if you get somebody to stay in the place for 3 years that they're also going to continue to stay for year 4, 5, 6. And the less turnover you have, the better you are on your cash flow. And at some point, when you have throughout all these 3 years accumulated enough reserves, you don't even need to put that aside anymore, which also adds to your cash flow. So there's a number of benefits. We are happy to help you to find our preferred turnkey provider who offers build-to-rent properties in Alabama and Tennessee, and we would love to work with you on that. So if you're not already a subscriber, I would like to ask you to subscribe to the channel. Give it a thumbs up if you like the video, ring the notification bell so that you get notified, and most importantly, share this video with other people, because I'm sure a lot of people who are fundamentally interested in real estate are now asking themselves, what do? I hear rents are increasing, I hear prices are increasing, I don't even know where to go or what to do, or can I even invest anymore? So yes, you can. There are ways, and if you find the right people, hopefully with our help, then you can become a successful investor and still keep working down the path towards your time freedom plan. So be well, stay safe, and I see you in the next video.